right. Well, happy Friday, everyone. Rich Swerbinsky with the Mortgage Collaborative here once again with the rundown with Rob and Rich, where we take you into the weekend by running through the week that was in the mortgage industry. And each week, pleased to be joined, my esteemed colleague and co-host, freshly landed in the Music City, Rob Chrisman. Rob, good to see you.
Good to see you too.
How's the Nashville airport? Vibrant?
It's bustling.
A lot of mortgage vendors.
Not yet. Did you say lenders or vendors? A lot of people.
Right. So we'll get into MBA annual a little bit as well in the show, but this week, pleased to be joined by a couple special co-hosts. And typically we dedicate a portion of this show to the news stories. They've just been so damn depressing, honestly. I mean, I want to talk a little bit more about the future and what lies ahead, and reached out to a couple great subject matter experts and resources within our network. Pleased to join to the show today, President of John Adams Mortgage out of Michigan, Larry Bsharah. Larry, good to see you.
Hi, thanks, Rich, for having me. Hello, everybody. Excited to talk about mortgage-related items today.
John Adams, a great real estate owned lender out of Michigan. Larry's been very engaged, longtime member at TMC, and he's been bringing up an issue related to trigger leads that is a major pain in the butt for a lot of our lenders right now. Talk about that a little bit, and also the real estate market, the realtor market, something Larry's very close to. So looking forward to getting Larry's perspective on that.
Yep, thank you.
Also, really pleased this week to be joined by the SVP Capital Markets for Nationwide Mortgage Bankers, Jeff Rosato. Jeff, thanks for joining us today.
Hi, Rich. Thanks for having me. Excited to be here to talk about this fantastic bond market we've all been living in.
Hey, Jeff, I want to ask you right off the bat, is it true the rumor that you were single-handedly behind adding premium MBS coupons onto the trading screens and trying to improve liquidity that way?
That was me. I just, a couple phone calls is all it took,
Good.
Any cap markets professional willing to come in the rundown hot seat after the week the bond markets had, you got to give credit to. So Jeff, we made him guarantee he would promise 30-year fixed rates in the threes by Christmas in exchange for coming on.
You told me Thanksgiving.
I might need to do a little bit more than a couple phone calls on that one, but.
All right, well, let's go ahead and get into it. Rob, I hate to start the show the same every week, but the bond market, the Federal Reserve continues to be the narrative that drives everything with the industry, because, we just kind of got like almost a freeze on business outside of people that absolutely have to buy a home or have to refi right now. It's the rate market's been kind of crazy. Not a good week for the bond market either this week. Really the bond market just really daring the Fed to stay the course, and almost begging for a step back, a little bit of the rhetoric that is just raise, and we're just going to keep vigilant. And we got a little bit of that today. One of the Fed governors, Mary Daly, made some comments that helped bonds and raised some eyebrows, essentially saying like, hey, we got to really worry about over tightening. Over tightening, could create unforced downturn. And we need to start to think about leveling, because we're starting to see some signs that would indicate a need to start to talk about leveling. So your thoughts on all the latest and greatest with the bond market this week?
Yeah, nothing goes in a straight line forever, right? So the interest rates up and down. Tomorrow morning, I put in a link to a story that Chris Whalen put out there. He wouldn't be surprised if we saw mortgage rates in the 10s early next year, which I don't necessarily agree with. In fact, I shot him an email. I said, "Is this really you saying this stuff?" And he said, "Yeah." That's about it. But nothing goes in a straight line forever, but you can't fight the Fed, and the Fed runs the risk of over tightening, absolutely. But for now, the market is fully priced in another 3/4 point hit to overnight Fed funds. And I'll tell you, Rich, you can go out and buy, rather than earn 0% on your money right now, you could, if you have a Wells Fargo account or Charles Schwab account and has some extra cash sitting around, not a lot of extra cash, but some, you can go out and get 3-month T-bills at like 4.2%. You can earn 4.2% on your money right now, just in 3-month treasuries. 6-month treasuries, a little bit more. So, of course, the banks, for the most part, are pocketing that gain. But, up a little, down a little. And I think that, yeah, we have a big risk of a hard landing. And the Fed has always been accused of tightening too much and causing a recession. They're certainly cognizant of it. But I wanted to ask Jeff, I was kind of joking around earlier about setting up, prime, or I should say premium MBS coupons. And Jeff, are you seeing any kind of production yet in terms of, like I said, don't fight the Fed. The Fed obviously has made it clear that they're going to keep raising for a while, but has production caught up with the current rate environment at all?
So not really. I mean, we've seen some volume come in 6 coupons, which really just started trading a couple weeks ago. But they're 6 coupon right now is on a Fannie UMBS right around par. So there really is no premium there. And on the Ginnies, it's even worse, so, and then you look at like a 5.5 coupon, you're trading down around 98. So there's no premium to be had right at like the, right from the start, just on the security pricing. And then, servicing values are down too, right? Because who's going to put a big SRP on their price when you're at rates that are, in the 7s, when a year from now rates might be back down to the 4 or 5 range, and that servicing is going to be worth nothing. It's all going to just refi. And that's been like a big problem for our loan officers, is you can't, even though now we have 7.5, 7.5/8 note rates on our rate sheets, there's no premium in there, and borrowers still have to pay discount points. So is it better to, and you kind of like plateau and level out at the higher end of the stack. So, if you're at 7 5/8, but you still got to pay a point, it might be better to just, take a 7 1/8 rate and pay like 1.5, right? For depending on how long you plan on keeping the mortgage for. So that's been like the big issue. It's like, yes, we have higher rates, but we still don't have the premium, and I think it just takes time for liquidity to fill into those higher coupons where you start seeing higher production and premium might start coming back. But what's crazy is like you look at like a 30-year interest rate today compared to a 10-year, it's 300 basis point spread. It's like the highest that I can ever remember it being. So I don't really know if there's much more. Like I thought we hit a bottom back at the end of September for MBS prices, but we broke new lows earlier this week. It looks like we're bouncing back a little bit today, but I really don't think that pricing can take much more to hit when you look at that spread between mortgage rates and 10-year treasury right now. So that might be a little bit of a positive glimmer.
Excuse me. The intermediate arms were a big deal. March, April, May of this year, all the credit unions and banks were offering some great 3-1, 5-1, 7-1 product. Has that product pretty much vanished with the with changes in the yield curve?
We've actually seen a couple arms recently, but not many. We didn't really see much back earlier in the year either. So one thing that we are running into is where you'll have banks and credit unions who are offering, the old, 7.5/3.1 LIBOR arms. They're probably just porting them and ridiculously low rates. So our loan officers are, why can't we have these arms? It's a 4% rate, back in May, and we're like, well, what we have from our correspondent investors from the agencies are the new SOFR arms, and the way that they're priced right now through the agencies and correspondent investors doesn't make sense at all to be doing one of those. So I think the banks and credit unions have a leg up on IMBs when it comes to arms, because they're able to just price much more aggressively. So that's been a struggle for us, with our loan officers. But overall, like arm volume is really minimal.
Yeah. And I need to ask you this, Jeff. I'd like to ask Larry as well. You can say if you want, or obviously not say if you don't want. But I am hearing about a pickup in repurchase requests from Fannie Mae and Freddie Mac, and oftentimes the mortgage rates of those repurchase requests, as you would expect, are 2 3/4 or 3 1/4, 3.5. And a lot of what I'm hearing is that their repurchase requests are based on income documentation not being thorough. Can either one of you address that chatter in terms of what you're seeing out there?
Yeah, I can just hit quickly just on the amount of repurchase requests coming from the agency. So like earlier in the year, Freddie really was picking up their pace on them. They were putting in requests for everything, and 9 times out of 10 it would be something that we'd be able to cure or fight and not not have to go through with. But recently, I feel like Freddie has come back more in line with Fannie. I think they've kind of met in the middle a little bit as far as like the amount of repurchase requests coming back, or just QC findings in general. Hasn't really been an issue for us, but I do know that Freddie was just killing everybody earlier in the year. But I think now they've kind of lightened up a little bit. They're more in line with what Fannie's doing. But as far as the types of requests coming back, I really can't speak for that.
We've seen, we've been hearing some additional requests for buybacks, a lot on the appraisal side, for appraisals or conditions or guidelines that can be pushed back on. I think they have a little bit more time on their hands, and they know that they can spend the time on digging into those guidelines a little bit more and trying to find reasons to push those back to the lender. We've been successful in any ones that we've received, but I know it's more than it has been in a very long time, the requests for the buybacks.
And the loans are generally performing, right?
Yeah, and they won't. We've in the past have been able to successfully work on indems when they are performing, but I'm hearing that's not working anymore either. When they're performing, and it's unfortunate that's the case. So
yeah. Rich, are you hearing that among your members?
Yeah, absolutely. I mean, I think it's been a consistent theme, and I'm putting together right now the agenda for our 12 days of TMC virtual event at the end of the year. We have a couple sessions just around, based on member feedback, ways to best practices to help mitigate buyback requests and how to deal with them when you get them. But certainly it's chatter we started to hear, to Jeff's point earlier in the year, TMC Miami in March. I was kind of not surprised, but taken aback at how much it had picked up already. And then, just continue to hear that as well. And the chat, I think, would indicate the same. Seeing a lot of commenters in the chat saying that they're seeing the same thing, increased buyback requests as well. So Larry, staying with you, real estate owned lender, just take us inside the realtor and the real estate world, if you could. It's obviously been a tough year on that market as well. And we just welcome any insight you have on that piece of our industry. Yeah,
thanks, Rich. Listings are lasting on the market a little bit longer today versus a year ago. A few months ago, earlier this summer, they continue to sit a little bit. Although the good homes, the ones that are all done and brought up to date, and new kitchens, flooring, are selling still pretty quickly. There's still a competitive feel out there, multiple offers in a lot of the homes that are done. We're seeing our average loan size decrease overall. So I think that lends to more of that for here in Michigan, in Southeast Michigan, that 250,000 and under price for the first time buyer is performing better than the higher priced. I think the drop in the stock market and in the rates and et cetera has given the upper end market a little bit of a pause in that. And those homes are sitting or not being listed. The real estate side of the world, anywhere here and nationwide is it's down. It's down 10, 15, 20% in some markets. I think the Midwest is feeling it a little bit more than than other areas of the country. I'm sure you're seeing that in Cleveland and in Ohio too, Rich. So the from a lender side, having that realtor relationship is critical, and that's, we're fortunate to be a part of it, but that doesn't guarantee any business. We still have to work very hard at earning that business from the realtor. So and we do a nice job of that. But on the real estate side, it's tough right now. It really is tough.
So, yeah, people still buying homes though. The
Sure.
existing home sale report that just came out. To your point, homes on the market a little longer. I think it was an average of 19 days homes bought in September versus 16 the month before. 70% of homes sold in September were on the market less than 30 days still, despite an interest rate climate in September that was not great. You know, it was rates in the sixes, if I remember correctly. And year over year, home sale prices up 8.8% from September of this year to September of last year. It's different. Obviously, we've been seeing the year over year 18%, 17%, 15%, then not on about 9%. So I thought it was interesting in the report, 127 straight months going back to 2011, where the average home sale price was higher than a year ago. It's been 11 years since we've had a month where the average home sale price was less than a year ago. We're going to hit that day this winter. That streak's going to be over, but I thought that was an interesting stat. And I want to get to this trigger lead issue
Yeah.
with you there, but real quick, I want to go back to this bond market issue one more second. So just trying to figure this out. I mean, like the way I'm looking at this right now, it's like the falling knife, you know, thing that's going on. I mean, bond investors, like if you invest in the stock market, you invest in sports, you invest in anything. If a market is plummeting, and you know, as yields on mortgage bonds go up, the prices of the bonds that people own are dropping as well. It's just, you know, you lose your pain tolerance, and eventually you're just like I'm sure a lot of people did with the stock market these last, like, I'm done, I'm out, like, you know, see ya, I'll check back in when things look a little rosier. Rob and Jeff, it feels like there's a ton of fear and loathing priced right now into the bond market, and that bond yields are much higher than they probably should be, but it's just like it's this bond investor versus Fed rhetoric thing, right, Rob?
So as I said earlier, Rich, don't fight the Fed, right? You don't fight the Fed, but there are, and speaking with bond investors, there are opportunities out there. And you talk about catching a falling knife. Well, at some point you step in, especially if your mandate is to buy mortgage-backed securities. The question is, what do you buy and where do you buy them, and what kind of coupon? And so there are opportunities out there. There is demand for mortgage-backed securities. You know, money managers are still buying them, insurance companies, pension funds, and so forth. So if you think about it, the supply, the new supply is way down. So you could say, well, the demand is down, but the supply might be down even more. And so the prices, I think, to Jeff's point, the longer we kind of stay at certain levels, the more liquidity that comes into the marketplace, the more originations catch up with the secondary market, the better off we'll be. Right now, there's a lot of uncertainty and chaos, and you're right. When things are uncertain, investors and people, it's just human nature to kind of step back and not jump in. But there's also a lot of opportunity. And when you talk to investors who are out there, yeah, they're cautiously buying and trying to pick up some value. But I'll turn that question over to Jeff.
Yeah, I mean, from a bond investor's point of view, there's obviously a lot of fear, right? And if you're not in the market, when do you jump in? That's a big question. But if you are in the market, like if you're an institutional investor and you have bond holdings, yeah, like your prices on your existing holdings are way down, and on paper it looks really bad. But if you're going to continue to hold them and just collect the coupons that you expected to collect initially at the start, then that doesn't really make a difference to you, right? So it depends on what type of investor you are. If it's like a long-term, like institutional investor in a mutual fund, I don't think they're just going to dump everything, right? But if you're just an individual bond investor, like, yeah, you would be thinking just like somebody was thinking about their stock portfolio back in 2008, right? Like you shouldn't sell, but you can't help yourself, and you unload at the worst possible time, right?
Yeah, Rich, to that point, Rich, you need to remember, oftentimes, if you're an insurance or company or pension fund or a financial institution, what is it that you're offsetting? You could be offsetting a position with owning these mortgage-backed securities. And if you are a bank or a credit union and you're paying basically still zero or near zero on bank accounts, and taking that money and investing in mortgage-backed securities that pay 6.5% or 7%, that's a sweet spread. So,
But
you have to
especially
keep
now,
that
I
in
mean,
mind.
mortgages are performing well. Employment, which is the biggest predictor of payment, is robust. Like at some point, but I think it's just like the prepay fear more than anything. That's why I think like if the fear can, if we see signs that inflation is abating, the Fed backs off their rhetoric and their actions a little bit, you get, mortgage bonds and mortgage rates back into the 5s or the 6s. I think bond investors would view the prepay risk on mortgage bonds in the 5s and 6s as dramatically different in theory a month from now than they would have at any point in the last 10 or 12 years, right? Because the future of interest rates is less certain. It's less likely that rates will be low in the future now than it has been, right, for a long time.
And can I just chime in? And Rich, you kind of said it, but I think what we need is a lot of stability, because if the uncertainty is there, you're right, we're not, the premium won't be there. The uncertainty now is how low will rates get, and how fast will my loan prepay if I'm a servicer. And without that stability in the market, those premiums and margins will never catch up. So as soon as we get the stability we need, then we'll start some things being normalized. I'm sure we could all live with 6.5%, maybe even 7%, as long as it's gonna be stable and that premium's there. Because think about it, in March we were in the 3s, right? We more than doubled in 6 months. That's tough to contend with.
Jeff, you noted the spread between the 10-year treasury and 30-year mortgage bonds right now is, it's 300 basis points. Typically it's about 200 basis points. And, like for an investor, if you're buying fixed income, you could buy a treasury. It's got zero risk. It's got a fixed return. It'll pay you whatever. And then, or you could buy a mortgage bond, and you get, with that, you get more yield, but you get prepay risk, you get delinquency risk. But as that spread widens, if it stays wide when rates are more normal and prepay risk is less of a fear, it would be very attractive to bond investors. No?
Yeah, absolutely. But I think it's, that Larry hit the nail on the head. It's all about stability, whether rates are going up or down, to have a more, smoother transition rather than what we saw this year is really what is going to dictate that, but, and then so if you think back to the Fed too, Rob is saying, you can't fight the Fed. And like, I agree completely. It's all about the Fed. So if they're targeting, 4 3/4 on the Fed funds rate by the end of the year, that's another 1.5, right? So like 3/4 of a point in November, 3/4 of a point in December. And if that spread at 300 basis points to the 10-year sticks, then you're probably looking at rates maybe early next year in the almost 8.25, right? If that spread stays. With the way that the mortgage-backed security market is right now, I don't think we can support 8.5% rates right now, because if we have no liquidity in the 6 and the 6.5 coupons, how long is it going to take for there to be any liquidity, let alone premium, in a 7 or a 7.5 coupon? So I think that spread is going to come. It has to come in, right? It's just a matter of what the Fed does, right? And then if they do over tighten and we start seeing a sharper recession than the mild one that is really being predicted, that how quickly do they move to lower rates, and I think as they lower rates, we'll see that spread come in as well. So I think we're at the point right now where it really can't get any worse, and I hope I don't just eat my words and
Amy, make sure to tape that segment, clip that segment in case
someone holds me to that a year from now.
no,
but I do. I think rates have gone, you look at that spread on 30-year rates to the 10-year, you look at the MBS pricing right now, and I really can't see mortgage rates going much higher between now and the end of the year, even with the Fed's increases planned.
This is the Rundown with Rob and Rich Swerbinsky with the Mortgage Collaborative, joined as always by Rob Chrisman. This week, the president of John Adams Mortgage, Larry Bsharah, and the SVP Capital Markets for Nationwide Mortgage Bankers, Jeff Rosato. Larry, trigger leads, an issue that we've been hearing some chatter about. You kind of formally brought it to the attention of the network yesterday. What we do, we're canvassing the network, getting the word out to people, seeing what they're hearing, and just a lot of buzz it created amongst the members yesterday. A common sore spot. If you could just outline the issue and kind of what we need to do as an industry to make it go away.
Yeah, well, I wish I had that kind of power to make it go away, but as a group, I think it's important that all of us try and do something. And some of you might be buying trigger leads, so hopefully I don't hurt your feelings. But so I think we all know what trigger leads are, and it's when we pull a tri-merge credit report and the credit bureaus, Experian, Equifax, TransUnion, sell our buyers information to other lenders, whether it's individual brokers out there, larger independent mortgage bankers. I'm sure it's a wide variety of different types of lenders. And within minutes, days, 1 or 2 days, borrowers are legitimately receiving 40, 50, 60 calls, texts because they know they're looking for a home. They know they've pulled a credit report specifically for a mortgage. And there's ways around it. There's ways you can pull a soft pull on your borrower versus a full tri-merge. But you can't run AUS through that. So I don't know if that's a legitimate way to go about that pre-approval or that approval process, because then you're creating more costs by pulling the soft pull and then the full tri-merge credit report to when they're ready to pull. And who knows, maybe you're giving a non-supported pre-approval because you haven't pulled that tri-merge. So you might be putting the borrower at risk. And I understand the reason that some think that a trigger lead, selling these trigger leads are good, and it's to help the borrower shop. But I think what the CFPB has put in place in promoting shopping and promoting getting second opinions, third opinions, was for the borrower to do that on their own terms, not for the credit bureaus to openly sell information. And it's obnoxious, and it looks like from a borrower perspective that the lender or the loan officer has sold their information. And so that puts loan officers and lenders in a bad light. So I don't know if anybody else has additional experience in that, but it puts us in an odd spot to have to explain it to borrowers prior to that credit report being run and then after. So I know there's a bill out there. I think since May or so, Richie Torres from out of New York has put the bill together. I think maybe we try and help push that along somehow, some way, to see if we can get that to pass.
Yeah, it's been sitting in the House since May. Looks like not a lot of action, but there is a bill in the House right now that would make this practice illegal. I would tend to agree. In other industries, when you apply for something, it's not as rampant. And to your point, Larry, the CFPB has put in place a number of measures to promote competitive options and really enforcing RESPA and lenders being steered or borrowers being steered to one lender. So maybe one of those things that in the past had more validity from a consumer protection standpoint than it does now. So and when we reached out to them, I remember saying I think we heard from a lot of them is it reflects poorly on them because the borrower applies with John Adams Mortgage and then they just
Or any
start
lender,
yeah, any lender, and the natural feeling and reaction of the borrower is, John Adams, they just pulled my credit. What the hell? Like, so something.
The opt out that Amy put in the chat, it could work. But it's I think it's a 1 to 3 week delay for the borrower to put their information in the opt out, and sometimes it just makes for a sloppier process for the consumer, and that's what we should be all about is the consumer experience for the approval process and closing process.
Hey, Larry, I have a question. The credit side of things here. I don't. The CFPB doesn't regulate it, isn't it? The FTC that's more involved.
Yeah, but correct. But the CFPB regulates us from a making sure they shop perspective. But yeah, I believe it's more of a credit side. Correct.
Well, it's certainly a pertinent issue, and any of our members that are listening that have feedback or want to connect with Larry or others on this issue, that's what we do. We're doing a lot of that today, so keep the feedback coming in. Getting close to wrapping up here, Rob. MBA annual in Nashville. Looking forward to seeing you and a lot of friends. At a time where it's been a tough year. I remember predicting I do a funny beginning of the year predictions column that's completely sarcasm, and sadly like a couple of these might come true this year. But looking forward to seeing people in Nashville and your thoughts and expectations on the coming show.
Well, Rich, I hope that you and I can share some alcoholic concoction in a ceramic cowboy boot with 2 straws like we did the last time you and I were in Nashville together. Was I not supposed to say that? Anyway.
That was just a few days ago. Yeah, no.
No, I think that I'm a little bit pessimistic about the show. I mean, it'll be, as always, good to see people. It's always good to see people in our profession because we have so many friends and friendly competitors and so forth, and acquaintances, and on and on and on. Some of the events will be fun, but I think the general subject matter will be relatively somber. And do you really care about what's going on in the industry, some of these long-term plans, when some of these companies, I think, are just trying to stay alive through the next couple quarters. And it's a tough environment. So I think any of the information that gets passed along will be more along the lines of how do you cut costs, and how do you stay afloat for some of these folks. And I'm sure there'll be some fair amount of M&A talk off the record in the hallways and at the gathering. So, but I'm looking forward to seeing everybody. It's a great business, and we do a good job out there for millions of borrowers.
The joke I heard was that the vendor to lender ratio, the LTV, is going to be so high you can't even get MI on it.
Yeah, I think lenders should maybe they should give them hats with a big L.
No, they're going to have like the glasses and the mustache thing, So TMC conferences, more lenders than vendors. Just saying. Any other thoughts, Jeff, to take us home into the weekend?
No, I'm looking forward to seeing a lot of people at the conference. Just two pieces of advice for anybody who's going, who has a lot of meetings, is one, don't stay out late. It's never a good idea when it's 12 o'clock and somebody says, hey, we're leaving here and going down to the next place. Say, no, don't stay out late. Number two is leave time in between meetings that you have scheduled, because you're going to bump into people that you haven't seen in a while that you're going to want to talk to. You're going to be running late all day long. So leave some time in between. But Rob, you sounded really like pessimistic about it. I think we need to be a little bit more optimistic. There should be a lot of vendors there. I'm sure I have tons of ideas about how to cut costs, and there's going to be a lot of lenders there with a lot of different products that might be able to help borrowers who just have really been struggling all year with affordability issues. So let's be positive.
There we go. I should be more positive. You're right, Jeff. I'll hang out with you at 11:59.
Larry, you heading to Nashville? We haven't talked about it.
I'm not heading to Nashville. No, it just didn't work for my schedule. So I'm sure it'll be well worth it. And I wish I was going. Because anytime people can get together and talk shop and mingle, and it's a good thing. So I wish I was going.
Any parting thoughts to take us into the weekend?
No, I just I'm with Jeff that the more upbeat we can stay for one another and to our realtor partners and referral partners, the better off we'll all be. We should be fortunate for the couple few years we've had, and we just got to get through a few tough months. So I think it's important to stay upbeat, think of the borrower. Maybe it's looking at more down payment assistance programs, or looking at ways to help promote home ownership in a different light. But be ready for a few months of a bumpy ride. So we just gotta stay positive. We're all career lifers that are on this call. We wouldn't be on this call if we weren't. So just stay positive out there.
Larry, you'll like my commentary tomorrow. I've got some great information from a West Coast realtor. I think you should check it out.
Okay, will do.
Good stuff. And to our attendees, thanks as always for wrapping the week up with us. So we're here every Friday from 3 to 3:40-ish p.m. Eastern with the rundown. Goal is to kind of capsize the week and save you some time by giving you some perspective of what's going on outside your silos in our crazy mortgage industry. So,
Rich, did you say capsize the week or summarize the week?
what did I say? Did I say capsize? Was that a Freudian slip?
Maybe I misheard. We'll have to replay the tape.
It's been a long year. So anyway, so have a great weekend, everyone. Thanks again, Jeff and Larry and Rob, and Jeff and Rob, I'll see you this weekend, and Larry, I'll see you soon, bud.
You got it. Take care.
Take care, everyone.
See you, Jeff. Nice meeting you.
Everyone, nice to meet you.
All right.
Bye.
Bye-bye.